Hi there, it's Friday the 5th of April 2019. I'm Steve Towers. Welcome to ITB. Let's get started. In France, the government has introduced into Parliament this week a new bill for the proposed digital services tax. The government says that the new bill contains amendments to prevent double taxation and to improve the transition to a global solution for digital taxation. For a copy of the new bill, please go to our website or app. In Austria, the government has presented a package of digital tax changes, including most notably an increased tax rate and increased threshold for its proposed advertising tax on online advertising. When originally announced in January, the online advertising tax was proposed to have a 3% rate. Well, that rate is now 5%. Also, the government has increased the thresholds for the tax to apply. In January, the proposed thresholds were global group revenue of at least 750 million euros and group revenue from Austrian advertising of at least 10 million euros. The first threshold is unchanged. However, the second threshold has been increased to 25 million euros. The government's package also includes proposed changes in regard to online platforms. For a copy of the government's press release, please go to our website or app. And in New Zealand, the government has released internal documents, including cabinet papers, which show its deliberations concerning whether or not to introduce a digital services tax. For a copy of these documents, please go to our website or app. A recently released academic paper on how to allocate profits to market jurisdictions has generated some interest. The paper, which was written by the Oxford International Tax Group, introduces a methodology which the authors call residual profit allocation by income, or RPA-I. It would be particularly relevant to the marketing intangibles proposal in Pillar 1 in the recent OECD consultation paper. For a copy of the Oxford International Tax Group's paper on RPA-I, please go to our website or app. The WTO appellate body has delivered its decision in the long-running dispute between the EU and the US concerning various incentives provided to Boeing. And I must say that it's interesting to see that both sides, the EU and the US, have claimed victory in the case. The EU was successful in regard to two of its claims. Firstly, that Boeing continued to benefit from tax incentives, the Foreign Sales Corporation provisions, and the extraterritorial income exclusion provisions under US federal income tax law, which had previously been ruled as illegal subsidies. And secondly, Boeing benefited from tax incentives provided by Washington state. But according to the US, the EU was unsuccessful in regard to 28 of its claims. For a copy of the appellate body's decision, the EU press release, and the US press release, please go to our website or app. And if you like tariff classifications, or if you like pets, then you should like this case. The US Court of International Trade has ruled that pet carrier products should not be classified under heading 4202, which comprises containers that organise, store, protect and carry various items, because pets are living beings and not items, but instead should be classified under heading 6307, which comprises made-up articles of textiles that cannot be classified under any other heading. For a copy of this case, please go to our website or app. The full Federal Court of Australia has decided an appeal in the RCF 4 case, which raises some interesting international tax issues. This is the latest instalment in a series of cases concerning RCF private equity funds. I dealt with an earlier RCF case called RCF 3 and with a lower court decision in RCF 4 in my previous video podcast series. You might remember them. This new case is long and complex, so I'll focus on those interesting international tax issues. But first, some background. Resource Capital Fund 4 LP, which I will call RCF 4, is a limited partnership formed under Cayman Islands law. It has many limited partners, almost all of whom are US residents. It also has a general partner, which is another Cayman Islands limited partnership. RCF 4 derived a profit on the acquisition and disposal of shares in an Australian holding company, which was the parent of a group which undertook mining operations in Australia. The case concerns the Australian tax treatment of that profit. An important point in this case is that RCF 4 is classified as a corporate limited partnership for Australian income tax purposes. That means that for Australian income tax purposes, RCF 4 is treated as if it is a company. In contrast, for US tax purposes, RCF 4 is treated as a transparent partnership. So, RCF 4 is a classic hybrid entity. Another important point to note is that RCF 4's disposal of shares in the Australian holding company was not by way of sale. Instead, it was by a scheme of arrangement. The significance of this point will be clear in a few moments. I'd like to take you through each of these issues. Nature of the profit. Is it ordinary income? Source of the profit. Treaty exemption. And can RCF 4 rely on a public ruling? The first issue concerns whether the profit derived by RCF 4 is ordinary income for Australian tax purposes. The share acquisition occurred in 2007 and the disposal took place in 2013. One of the witnesses who gave evidence in the lower court described the business activity of the RCF private equity funds in this way. The investors would go in, make the investment, improve the performance of the company concerned, and then seek to exit within 3 to 6 years after that time, having made a profit. Based on these facts, the lower court held that the profit does constitute ordinary income. This is consistent with a line of Australian cases which goes back several decades. The taxpayer did not appeal against the lower court's decision on this issue, and so the full federal court accepted that the profit was ordinary income. The second issue concerns the source of the profit. If the profit is ordinary income, it will be taxable in Australia only if it is sourced in Australia. Australia uses a practical, hard matter of fact approach to source questions. There are no specific rules. The facts in this case include some factors which point to a foreign source and some factors which point to an Australian source. However, the full federal court placed considerable weight on two particular factors. The first factor was described by the court in this way. The lower court noted that the business strategy of the taxpayer included substantial activity in Australia. That strategy comprised not merely a passive holding of shares, but an acquisition of shares and then a restructure and management of the underlying business in order to secure a better profit from a future sale. The general partner of RCF4 had entered into an agreement with RCF Management LLC for the management of the operation and investments of the partnership through an investment committee. For that purpose, RCF Management had entered into an agreement with RCF Management Proprietary Limited, RCF Management Australia, pursuant to which administration and management services were supplied. The lower court's findings include the fact that RCF Management Australia employees played an active role in the management, including the ultimate disposal of the investment. And whilst it is true that those employees were not employed by RCF4, they were employed by a company which, inferentially, was ultimately controlled by RCF4, or at the very least, existed to serve the interests of RCF4. In substance, those employees helped manage the investment in the Australian holding company for RCF4. And the second factor relates to the method of disposal, the scheme of arrangement, which is a special procedure under the Australian company law. The full federal court said this: what bound RCF4 to dispose of their shares and interests in the Australian holding company was not the entry into a contract of sale overseas, but the convening of the scheme meeting to be held in Australia, the approval at that meeting of the scheme of arrangement, the approval of that scheme by the court, and the lodging of the order of the court with the Australian corporate regulator. Approximate origin of the profits here was thus the scheme of arrangement, and the location of that arrangement was unquestionably in Australia. And so the full federal court concluded that the source of the profit was Australia. That means that the profit is taxable in Australia unless treaty exemption is available. The next issue is the availability of treaty exemption, the relevant treaty being the Australia-US Treaty. By a 4-1 majority, the full federal court held that RCF4 is not a resident of the US under that treaty, and thus it cannot claim treaty benefits. However, the court stated that the US resident limited partners would be able to claim treaty benefits, but only in the appropriate circumstances, such as in recovery proceedings brought by the tax authorities. However, the US resident limited partners could not claim treaty benefits in the appeal before the full federal court, because the relevant assessment was correctly issued to RCF4, not the limited partners. And the fourth and final issue is, can RCF4 rely on a public ruling? The tax authorities had issued a public ruling which indicates that certain profits derived by hybrid corporate limited partnerships, where the limited partners were resident in a treaty country, were tax exempt in Australia under the treaty. That public ruling was binding on the tax authorities. RCF4 argued that it could claim the benefit of the public ruling, even though it could not claim under the treaty. The full federal court held that the public ruling only addresses situations where the business profits article, Article 7, of the treaty applies. However, in RCF 4's situation, Article 13 applied instead of Article 7 because the Australian holding company qualified as a land-rich company. Therefore, said the court, the public ruling was not applicable to RCF 4. Remember that in regard to the third issue, treaty exemption, I said that the court reached two conclusions. The first is that RCF 4 is not entitled to treaty benefits under the Australia-US Treaty because it doesn't satisfy the definition of resident of the US in that treaty. And the second is that the US resident limited partners would be able to claim treaty benefits, but only in appropriate circumstances, such as in recovery proceedings brought by the tax authorities. However, the appropriate circumstances would not include the present case, in which the assessment issued to RCF 4 is being challenged. Now, you might wonder, would the US resident limited partners be entitled to a treaty exemption in regard to RCF 4's profit, although in recovery proceedings? The answer is no. In regard to the fourth issue, can RCF 4 rely on a public ruling, the court concluded that Article 13 of the treaty would apply because the Australian holding company was a land-rich company, and Article 13 would allow unlimited Australian tax on that profit. So the US resident limited partners would be able to claim treaty benefits, but they would not qualify for an exemption under Article 7 because Article 13 would apply to allow unlimited Australian tax. For a copy of this case, please go to our website or app. The UN Committee of Tax Experts is scheduled to have its next meeting on the 23rd to the 26th of April. In preparation for the meeting, the UN has released 6 documents which are listed here. For a copy of the documents, please go to our website or app. In Australia, the government has presented its 2019 budget with one eye on the imminent general election. There were very few changes of relevance to multinationals. Here are the items worth mentioning. The government will provide significantly more funding to its tax avoidance task force, which has been successful in collecting additional tax from multinationals. There are some minor amendments to the hybrid mismatch rules, and 8 jurisdictions have been added to the list of information exchange countries. This means that distributions from managed investment trusts to these countries may qualify for the 15% withholding tax rate instead of 30%. And the Australian tax authorities have issued 2 items of guidance. The first, TA 2019/1, concerns multiple entry consolidated groups, MEC groups, avoiding capital gains tax through intra-group debt. And the second, TD 2019/D1, is draft guidance on the meaning of restructuring for the purposes of demerger relief. For copies of these 2 items of guidance, please go to our website or app. In India, the Delhi Income Tax Appellate Tribunal has decided 2 cases in regard to the transfer pricing aspects of advertising, marketing and promotion, AMP, expenses. Interestingly, in both cases, the tribunal held that the incurring of the AMP expenses by the Indian company was pursuant to an international transaction with the non-resident related party. For a copy of these two cases, please go to our website or app. In Thailand, the government has announced that the grandfathered tax incentives won't be grandfathered anymore. They will be fully repealed effective the 1st of June 2019. Let me give you some background. In October 2018, the government announced the repeal of several existing tax incentive programs and their replacement by a single International Business Centre (IBC) regime. This move was in response to BEPS Action 5 on harmful tax practices. The repealed regimes are Regional Operating Headquarters (ROH) 1 and 2, International Headquarters, Treasury Centre and International Trading Centre. However, importantly, that announcement said that for companies which have a current incentive under one of these regimes, the incentive will remain valid until its term expires, with the exception of ROH 1, which was stated to cease at the end of 2020. Under the latest government announcement, all of the current incentives, including ROH 1, will be repealed for corporate income tax purposes effective the 1st of June 2019. Dividends paid to non-resident shareholders out of qualifying profits derived before the 1st of June 2019 will be exempt from the 10% dividend withholding tax, provided the dividends are paid on or before the 31st of December 2020. And individual income tax incentives for qualifying foreign employees will cease effective the 1st of January 2020. Of course, the government would like multinationals to switch over to the new IBC tax incentive, which will offer corporate income tax rates of 8%, 5% and 3%, generally depending on the amount of local spending. The rules and procedures for IBC incentive applications are expected to be released soon. The European Court of Justice has decided a VAT case in regard to the zero rating of goods exported from an EU member state, Czech Republic, to countries outside the EU. The issue was whether the zero rating still applies in the situation where the taxpayer proves that the goods actually left the EU, but the goods were not placed under a customs export procedure. Or alternatively, should the supply be subject to standard rate VAT? The court held that in the absence of tax evasion, yes, zero rating still applies. For a copy of this case, please go to our website or app. The European Commission has announced the results of its in-depth state aid investigation into the group financing exemption under the UK's CFC rules. It has concluded that part of the group financing exemption is illegal state aid and the other part is not. The Commission's press release says this: the Commission found that when financing income from a foreign group company channeled through an offshore subsidiary is financed with UK connected capital and there are no UK activities involved in generating the finance profits, the group financing exemption is justified and does not constitute state aid under EU rules. Conversely, the Commission found that when financing income from a foreign group company channeled through an offshore subsidiary derives from UK activities, the group financing exemption is not justified and constitutes state aid under EU rules. And, alluding to Brexit, the Commission said, as long as the UK is an EU member state, it has all the rights and obligations of the membership. In particular, EU competition law, including EU state aid rules, continue to apply in full to the UK and in the UK until it is no longer a member of the EU. The UK government is now required to collect the extra tax from the relevant companies. For a copy of the Commission's press release, please go to our website or app. The Commission has also announced that it has commenced an in-depth state aid investigation into Slovakia's tax on the food retail sector. The Commission's press release says this: under the tax, food retailers would pay a quarterly tax amounting to 2.5% of their total turnover. However, food retailers would be fully or partially exempted from the payment of the tax if they fulfill one of several conditions concerning their size, geographic scope of operation in Slovakia, and/or type of activities. Furthermore, retailers that are members of trading alliances or franchises would also not pay the tax, despite the fact that their combined turnover is comparable to that of the largest retailers. The application of these tax exemptions would result in only 7 food retailers having to pay the tax, 6 of them owned by companies based in other member states. The only Slovak-owned retailer subject to the tax would have a significant part of its turnover exempted. For a copy of the Commission's press release, please go to our website or app. In Romania, the government has removed the requirement for mandatory VAT split payments. This follows an instruction from the European Commission in November 2018 to do so. Romania remains as the member state with the largest VAT gap. Over 35% of VAT is lost for various reasons, including fraud. In Turkey, the government has published Presidential Decree 842, which changes the interest withholding tax rates on foreign bonds and some other financial transactions. In regard to foreign bonds, the new interest withholding tax rates are 7% if the maturity period is less than 1 year, 3% if the maturity period is from 1 year to 3 years, and 0% if the maturity period is more than 3 years. The new rates are effective the 21st of March 2019. For a copy of Decree 842, please go to our website or app. And in the UK, the First-Tier Tribunal has decided a case in regard to the EU's freedom of establishment. The tribunal held that the UK's rules for intra-group disposals of assets breach the freedom of establishment because they do not allow payments in instalments. For a copy of this case, please go to our website or app. The East African Court of Justice has decided a case in regard to Uganda's imposition of additional excise duty on cigarettes which were manufactured in Kenya and imported into Uganda. Both Uganda and Kenya are members, partner states, of the East African Community. Uganda's excise duty rate on the Kenyan manufactured cigarettes was higher than the rate imposed on equivalent cigarettes which were manufactured in Uganda. The court held that the higher excise duty rate breached community law. For a copy of this case, please go to our website or app. In Namibia, the government has presented its 2019 budget. Only a few items caught my eye. There will be a revamp of tax incentives, out with the current tax incentives for manufacturers and exporters of manufactured goods, out with the current export processing zones, and in with the new special economic zones. Deductions for outbound payments of service fees, royalties, and interest will be disallowed unless proof of withholding tax payment is provided. Deductions for mineral royalties will be disallowed for non-diamond mining entities, and foreign source income will become taxable. And in Zambia, the government has announced the deferral of the introduction of sales tax and the repeal of VAT from the 1st of April 2019 to the 1st of July 2019. The new sales tax will be a single-stage tax which will be imposed on goods and services supplied to consumers. The objective of the change is to collect more revenue. The government is frustrated with the amount of VAT revenue it loses through fraud. In Bahrain, the tax authorities have released 3 items of guidance on VAT. The first is on the VAT treatment of financial services, which includes insurance and reinsurance, fund management, intragroup loans, and Islamic finance. The second item is on the VAT treatment of the digital economy. And the third is on the VAT treatment of healthcare. For a copy of the 3 items of guidance, please go to our website or app. In Saudi Arabia, the tax authorities have also released 2 items of guidance on VAT. The first is on the VAT treatment of Islamic finance, and the second is on the VAT treatment of the transfer of business. For a copy of the 2 items of guidance, please go to our website or app. In Barbados, the government has presented its 2019 budget. A few items caught my eye. A thin capitalisation rule in regard to non-resident related party debt will be introduced, effective the 1st of September 2019. A debt-to-equity ratio of 1.5 to 1 will apply. Transfer pricing rules will be introduced, and withholding tax on outbound payments of interest, royalties, and service fees will be abolished, effective the 1st of April 2019. In Canada, the tax court has decided a case in regard to Canada's R&D incentive, which is called Scientific Research and Experimental Development, SRED. The case concerned an engineering company which undertook a project to develop software which would allow the arrival time for public buses to be accurately predicted. The court held that the project satisfied the definition of SRED. For a copy of this case, please go to our website or app. In the US, a topic which is receiving a lot of attention in conferences is the negative incentive which the GILTI expense allocation rules provide for expenditure on R&D conducted in the US. The problem is a familiar one: the impact of expense allocation rules on foreign tax credits. Here, the issue is that R&D expenditure incurred in the US can be allocated against GILTI, which could then cause a reduction in foreign tax credits and a spike in the US effective tax rate on GILTI. Those consequences would not occur if a US multinational conducts its R&D outside the US. So, in a perverse way, the expense allocation rules provide an inducement for US multinationals to move their R&D operations outside of the US. Obviously, this was not intended. US Treasury officials indicated this week that they are very aware of the problem and suggested that the issue would be addressed in the final version of the foreign tax credit regulations. And now for this week's treaty developments. We've had one treaty signed, one protocol signed, and one treaty enter into force. I have two articles for you this week. The first article is called Withholding Taxes Within the Internal Market After Safina, Chronicle of a Death Foretold. It's written by Ward Willems and it's published in the EC Tax Review. You'll remember the Safina case, which was decided by the European Court of Justice in November 2018. The court concluded that the imposition of French dividend withholding tax on dividends paid by a French company to a loss-making Belgian company breaches the EU's free movement of capital, and that such breach could not be justified. This article gives a good description of the facts and issues in the Safina case. In particular, it focuses on the most controversial aspect of the case, the fact that the position of the loss-making Belgian company was compared with the position of a loss-making French company, which apparently departs from the principle of territoriality. The author writes this: "More remarkable is that the court, in its judgment, compared the situation of a non-resident in deficit for CIT purposes with a resident in deficit for CIT purposes. One could question whether such comparison is correct. A non-resident in deficit will, in many cases, be in deficit because of expenses or losses that are not connected to the activity in the source country that produced the income. By taking into account a deficit arising with respect to an activity or income that is not connected to the source state, the court seems to have departed from the principle of territoriality with respect to non-residents, as it previously accepted in Futura." The author concludes that the Safina decision might severely complicate the continued application of withholding tax regimes in the many EU member states applying such rules. He writes, "It seems that the CJEU in Safina has taken another step towards eliminating withholding taxes within the internal market. After the dust cleared on the obligation of taxation on a net basis, following cases such as Miljan and Breisel, the court now considered one of the main features inherent to withholding taxes to be problematic, namely the timing difference of the tax levy and the cash flow disadvantages it produces. Responding to Safina might prove burdensome for member states, as it would require monitoring the tax position of a non-resident during an indefinite period. Questions furthermore remain on how to correctly introduce such response by immediate exemption or refund, and how the existence of a deficit should be assessed in this respect. The specific answers to these questions might further complicate the administration of withholding taxes and might be crucial for the future use of this taxing technique within the internal market." The second article is called Why Can't the English?, which of course is a reference to My Fair Lady. The article is written by John Avery Jones, and it's published in the Bulletin for International Taxation. This article analyses the position of English amongst the languages which are stated to be official languages in double tax treaties, and there are some interesting results. In a group of 7 English-speaking countries, Australia, Canada, Ireland, New Zealand, South Africa, the UK and the US, which have entered into a total of 574 double tax treaties, the author presents these figures. 31% of the treaties have English as their only language. 63% of the treaties use 2 or more languages, of which one is English, but there is no prevailing text. In other words, no language is stated to have priority. And 7% of the treaties use 2 or more languages, including English, but the prevailing text is English. The corresponding figures for all other countries, which have entered into a total of 2,809 double tax treaties, are these. 17% of the treaties have English as their only language, 10% use 2 or more languages, including English, but there is no prevailing text, and 53% use 2 or more languages, including English, but the prevailing text is English. Notice the last 2 numbers for each of the 2 groups. 63% and 7% for the group of English-speaking countries, and 10% and 53% for the group of other countries. According to the author, the differences between these 2 sets of numbers is significant. It indicates that in double tax treaties which use 2 or more languages, including English, it is far less likely for the prevailing text to be English in the treaties entered into by the group of English-speaking countries when compared with all other countries. The author writes this: one can understand the natural reticence of English-speaking countries not to ask for their own language text to be the prevailing text, but this must surprise the other country, as most are already adopting a prevailing English text in their other tax treaties. If the English-speaking countries fell into line with the rest of the world by using an English prevailing text, they would not be suggesting that English is in any way a superior language. I am sure that when French was the diplomatic language, the French did not worry about why they used it. They used it because everyone did, and it was not a topic for discussion. I suggest that we should now recognize English as the universal language of tax treaties. I emphasize that I am not suggesting that all tax treaties should be in English, or even that all should have an English prevailing text, because if 2 French-speaking countries want to make a tax treaty in French, that is obviously the best thing to do, and similarly for other languages. Just as when French was the diplomatic language, 2 English-speaking countries made their tax treaties in English. The advantage of a universal language is when, as is normally the case, the parties have different languages. That is no different when the universal language happens to be that of one of the parties. This is a very interesting article, but I think that the numbers might need to be reviewed. You'll remember that the author used a group of 7 English-speaking countries: Australia, Canada, Ireland, New Zealand, South Africa, the UK and the US. I guess that what he means by English-speaking countries are those countries where the tax law is in English, and thus it would be natural for those countries to want to use English in their tax treaties. But if that's the test, I would wonder why some other countries, for example India and Singapore, but there are many others, are not included in that group. Well, that's the way it is this Friday, the 5th of April 2019. I'm Steve Towers. Have a great weekend.